Every single day, forces you've never heard of are moving your money. The Fed, AI, geopolitics, currency wars. Most people only see the headlines, but they completely miss the signal beneath the noise. Well, that's exactly what MacroSignal is for. Welcome to today's Explainer, where we're going to dive into a massive tectonic shift happening in the global financial system right now.
Think about this for a second. Every dollar in your wallet, every dollar in your savings account, every dollar in your investment portfolio, they all have one big thing in common. Their value depends on the rest of the world agreeing to use dollars. Now, for 80 years, the world agreed. But right now, for the first time since 1995, the dollar's share of global foreign exchange reserves has actually fallen below 57%. Countries representing nearly 48% of the world's population are actively building payment alternatives. And here's what almost no one is explaining clearly. If they succeed, even partially, it is absolutely going to affect your mortgage rate, your savings return, your retirement account, and the price of everything you import. This is what de-dollarization actually means for your money.
So let's start with the hard data. According to the International Monetary Fund, the US dollar's share of global foreign exchange reserves has dropped to exactly 56.9%. That is a huge milestone. Slipping below 57% for the first time in nearly 3 decades isn't just some random blip. It's a fundamental structural shift in how the world handles money.
Section 1. The signal beneath the noise.
What's really critical to understand here is the timeline. The dollar didn't just suddenly crash overnight, right? At its peak back in 2001, the dollar made up a massive 72% of global reserves. By 2014, that number was down to 65%. And now, in 2025, we're sitting at that 56.9% mark. So we're talking about a steady, structural erosion over 2 decades that is suddenly starting to accelerate. It's like a slow-moving macro force that's finally hitting a tipping point.
Now, you've probably seen all the scary doom and gloom headlines about de-dollarization. So let's do a quick reality check. De-dollarization is absolutely not the immediate fiery collapse of the US currency. It's really just a gradual reduction. It's driven by nations actively diversifying their financial exposure because they want to shield themselves from geopolitical risks. Basically, we're slowly moving toward a multipolar currency system, not a world with $0.
So why is the pace accelerating right now? Well, the major catalyst was 2022, when Western governments froze roughly $300 billion in Russian central bank reserves following the invasion of Ukraine. It sent an absolute shockwave through global markets. Look, regardless of the politics, from a purely financial perspective, this proved to other nations that relying entirely on the dollar carries serious geopolitical risk. As Russian economist Yevgeny Buryakov pointed out, countries are actively looking for tools to protect themselves against sanction risks.
Section 2. The push for alternatives.
Here's the crucial thing. You literally cannot replace a currency without replacing the plumbing it runs on. For decades, the Western-led dollar-dominant SWIFT system has been the only game in town. But alternative infrastructure is scaling up incredibly fast. For example, China's cross-border interbank payment system, or CIPS, processed $25 trillion in volume in 2025 alone. That's massive. And alongside platforms like mBridge, the BRICS bloc is wiring up entirely alternative clearing systems. Their goal isn't necessarily to kill the dollar tomorrow, but to make it just one option among several.
Just think about how insanely fast this timeline is moving. In just the last 4 years, we went from the freezing of Russian reserves in 2022 to BRICS expanding to include major energy producers like Saudi Arabia and the UAE in 2024. Then in 2025, they launched a gold-backed digital trade currency prototype called the Unit. And by early 2026, Iran is implementing yuan-denominated transit tolls at the Strait of Hormuz. The parallel infrastructure is actually going live.
And how do you back up a brand new financial system? You hoard an unprecedented amount of physical assets. The combined gold reserves of BRICS member states now exceed 6,000 tons. Russia and China are leading the pack, followed really closely by India. They are basically building a fortress around their economies to block out dollar volatility by anchoring to physical sanction-proof gold.
Which brings us to this staggering number right here, over 1,100 tons. That is the estimated amount of gold purchased by global central banks in 2025 alone. This marks the longest sustained central bank gold buying period in modern history. Think about it. When the folks who literally print the money start trading it in for gold at record levels, everyday retail investors absolutely need to pay attention.
Section 3. The gold and oil shift.
Since 1974, American financial hegemony has basically rested on the petrodollar system. It is a brilliant, self-reinforcing loop. Step 1. Global oil is priced exclusively in US dollars. Step 2. Every country on Earth needs to buy dollars to buy their oil. Step 3. Oil exporters take those massive surplus dollars and recycle them by buying US government debt, which funds America's deficits. For decades, this loop created a constant, unstoppable demand for the greenback.
But right now, we are seeing real, tangible fractures in that loop. India, which is a top 5 global importer, is bypassing the dollar entirely to buy Russian crude using Chinese yuan, UAE dirhams, and Indian rupees. We've got Saudi Arabia increasingly selling oil to China priced in yuan. And maybe most provocatively, Iran is charging yuan-denominated tolls for ships passing through the Strait of Hormuz, which is the world's most critical oil choke point. These are live stress tests of a 52-year-old financial system.
And you know, this isn't just happening out of wartime necessity anymore. It's becoming a core ideological pillar for emerging markets. At a recent BRICS summit, Brazilian President Lula da Silva straight up asked, who decided that the dollar was the trade currency? This push to trade in local currencies is gaining serious mainstream traction across the entire developing world.
Section 4. Why the dollar survives. Okay, before we go declaring the end of the American era, we need a rigorous reality check. The dollar still has an immense, almost unassailable moat. When money actually moves across borders, the dollar is absolutely still king. According to the Bank for International Settlements, nearly 90% of all foreign exchange transactions still involve the US dollar. The Chinese yuan, even with all its rapid growth, sits at just 8.5%. The structural dominance of the dollar in everyday global trade is still very much intact.
The reason for that dominance is honestly pretty simple. You cannot replace the dollar without a viable alternative, and right now, neither the euro nor the yuan are ready for the job. The euro is backed by multiple countries, but it lacks a single unified fiscal treasury to back it up in a major crisis. The Chinese yuan has strict capital controls and isn't freely convertible, meaning investors can't just easily move their money in and out. The US dollar, meanwhile, boasts the deepest, most liquid, and most trusted government bond market on the planet.
Plus, add this massive number to the equation, $14 trillion. That is the amount of offshore, dollar-denominated credit currently held globally. Corporations, foreign governments, and banks all around the world have taken out loans in US dollars. The global economy is simply too deeply in debt in dollars to just walk away from it. Switching away would require rewriting millions of contracts. The network effects here are incredibly sticky.
Section 5. What this means for you.
Let's connect these massive macro dots directly down to your personal wallet. Step 1. As countries start trading more in local currencies, foreign demand for US dollars slowly drops. Step 2. Foreign central banks buy fewer US treasuries. In fact, foreign ownership has already fallen to roughly 30%. Step 3. To fund its deficit, the US government has to offer higher interest rates or yields just to attract new buyers. Step 4. Because treasury yields act as the baseline for the entire economy, your domestic borrowing costs go up. This directly pushes up the cost of your home mortgage and your auto loans.
And the impact goes way beyond just borrowing. A structurally weaker dollar essentially acts as a hidden tax on the American consumer. It means higher costs for imported goods, which leads to stickier domestic inflation. If it costs the US government more to finance its debt, that friction flows right down into higher interest rates for everyday personal loans. It's all connected. So what do you actually do about this? Financial analysts suggest a few tangible, actionable portfolio strategies to navigate this shift. First, consider maintaining a 5 to 10% allocation in physical gold. I mean, if central banks are hedging with it, it's definitely worth considering for yourself. Second, look at increasing your exposure to non-US developed market equities to diversify away from total dollar reliance. And finally, be cautious with long-dated US treasuries. You might want to reduce duration to avoid getting trapped by those structurally rising yields we just talked about. All right, let's wrap this up. The transition to a multipolar currency system isn't going to happen overnight, but the blueprint is already being drawn, and the actual infrastructure is being built as we speak. The days of absolute, unquestioned dollar dominance are slowly giving way to a much more fragmented reality. So I want to leave you with this question. As the world builds a parallel financial system, is your portfolio actually prepared for a future where the dollar has to share the stage? Think about it. Make sure your money is positioned for the signal, not just the noise. Thanks for joining this explainer, and keep your eyes on the macro signals moving your wealth. Catch you next time.